Welcome to your personalized deep dive. Today we're tackling something pretty exciting, but maybe a little intimidating for some folks, stock market investing. You've sent over some really cool beginner-friendly resources, and we're going to use those to really explore the fundamentals.
Okay.
Like, why even bother investing?
Right.
What stocks actually are?
Yeah.
Different approaches you can take,
Yeah.
and that, the whole index funds versus ETFs debate.
That's a big one.
It is a big one. It's a lot to cover, but we're going to make it fun and easy to understand. Right.
Absolutely. I'm excited to dive in. It's so fascinating to me to see how just even a basic understanding of how the stock market works can really empower people to kind of take control of their financial future.
Totally. And speaking of empowering, one of the first things that jumped out at me from the stuff you sent was the data on historical returns.
Yeah.
I mean, did you know that over the past century, the stock market has delivered an average annual return of 10.5%?
Yeah.
That's crazy. That's despite wars, recessions, you name it.
It's pretty impressive.
It is.
It really speaks to the resilience of the market and its ability to generate wealth over the long term. What I think is even more interesting is that those returns have been fairly consistent over different time periods. So like over the past 30 years, it's been 9.9%. Over 50 years, it goes up to 10.8%.
So it's not just a fluke of a particular decade or two.
Yeah.
It's a pattern that's held true for a really remarkably long time. I guess that's why they say time in the market beats timing the market.
That's exactly right. It is really difficult to try and predict short-term market movements,
Right.
even for seasoned professionals. So rather than trying to outsmart the market, it's generally more effective to just invest consistently over time and then let those long-term growth trends work their magic.
That makes a lot of sense. That brings up a question I've always had. Okay, so we hear these impressive average returns, but like, what does that actually mean for like an individual investor? Like, can you give me a real world example?
Sure. So imagine you invest $10,000 in the stock market and earn an average annual return of 10%. After just 1 year, your investment would grow to $11,000. But here's where the magic of compounding comes in.
No.
In year two, you're not just earning 10% on your initial $10,000, you're earning it on the $11,000. So your investment would grow to $12,100. And this just continues year after year.
So it's not just about the yearly return, it's about the fact that those returns are building on each other over time.
Exactly.
Like a snowball effect.
Precisely. And the longer you stay invested, the more powerful that compounding becomes. That's why it's so crucial to start investing early, even if it's with small amounts.
Got it. So we've established that investing in the stock market can be like a really powerful way to grow wealth over time.
Yeah.
But what exactly are we investing in when we buy stocks?
So when you buy a stock, you're essentially buying a tiny ownership stake in a company.
Oh, okay.
It's like owning a small piece of a giant pie.
I like that.
And as the company grows and profits, the value of your piece of the pie increases.
Okay, that's a really helpful analogy. So, like, instead of just buying a product from a company, like, you can actually buy into the company itself and share in its success. So let's say I'm ready to dip my toes into the stock market. Like, what are the practical steps involved in actually buying stocks?
The first thing you'll need is a brokerage account.
Okay.
This is basically a specialized bank account designed for holding and trading investments. Luckily, there are a ton of great options out there now, and many of them offer zero commission trading. So you don't have to pay fees every time you buy or sell a stock.
Oh, that's awesome. Especially for beginners, like no hidden costs to worry about. So I set up my brokerage account, I transfer some money over from my regular bank account, and then what? Like, how do I actually choose which stocks to buy?
So that's where it gets interesting, and this is where your personal investment style comes into play.
Yeah, I remember reading about different investment styles in the materials I sent you, and I was so struck by the fact that there were like approaches for different personality types.
Right.
It's almost like choosing a character in a video game.
I like that analogy. So you've got your buy and hold investors who are in it for the long haul. They pick companies that they really believe in and just hold on to their stocks for years, sometimes even decades, just weathering any short-term market storms.
That's the patient and steady approach, kind of like what Warren Buffett would do.
Exactly.
Exactly. Okay, and then you have your traders who are much more active.
Yes.
They're constantly buying and selling stocks.
Yes.
Trying to capitalize on short-term price movements.
Yeah.
Like they're really drawn to that excitement and challenge of trying to time the market.
It's definitely a faster-paced game.
It is. It seems like it requires a really different set of skills and risk tolerance. Then there's the speculators. They're kind of the high rollers, right?
They tend to be. Yeah, so they're attracted to riskier investments that have the potential for huge gains, but also higher chances of losses. So they might invest in things like emerging markets or penny stocks or companies that are developing groundbreaking but unproven technologies.
So that's buy and hold for the patient traders, for the active, and speculators for the risk takers. What about those who prioritize a steady stream of income from their investments?
Right, so that's where dividend investors come in.
Okay.
They focus on companies that have a history of paying out a portion of their profits to shareholders in the form of dividends. So it's kind of like getting a regular bonus check from the
Mhm.
companies you own.
So you're not just relying on the stock price going up. You're actually getting paid just for holding the stock.
That's right.
That's a nice little bonus. But I think with so many different styles, it can be a little bit overwhelming for somebody just starting out.
It definitely can be. And that's why for beginners, I often recommend that buy and hold approach, and particularly with investments like index funds, which are designed to be diversified and relatively low risk and can provide a really solid foundation for building a long-term portfolio.
Okay, index funds.
Yeah.
They seem to be all the rage these days. So let's break down what they are and why they're so popular, especially for beginners. I've also heard a lot about ETFs, or exchange-traded funds. Are those the same thing?
So they are similar in some ways, but there are some key differences. Let's start with index funds. Think of them as baskets of stocks that track a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies.
Okay, so instead of trying to pick individual stocks,
Yeah.
I could just buy an index fund that tracks the entire S&P 500
Yeah.
and, like, in a way, own a tiny little piece of all those companies.
Exactly.
Got
And
it.
that's actually one of the biggest advantages of index funds, instant diversification. Instead of putting all your eggs in one basket by investing in a single company, you're spreading your risk across hundreds of companies.
That makes a lot of sense, especially for someone who's new to investing and maybe doesn't have the time or the expertise to research every single company.
Yeah.
Are there any downsides to index funds?
Well, because they track a specific index, their performance is limited by the performance of that index. So
Yeah.
you can't really expect an S&P 500 index fund to outperform the S&P 500 itself.
So you're not going to beat the market with an index fund, but you're also unlikely to significantly underperform it. It's kind of like a steady, reliable performer.
Exactly. And there's actually a lot of data to support that. So, for example, a 2020 study by SPIVA found that over the past 15 years, over 85% of actively managed U.S. stock funds underperformed their benchmark index. So that's a pretty compelling argument for passive investing with index funds.
Wow, 85%. That's a pretty staggering statistic. So index funds seem like a pretty solid option, especially for beginners who are looking for like a diversified and relatively low risk way to invest in the stock market. But what about those ETFs we mentioned earlier? How do they fit into the picture?
So ETFs are also baskets of stocks that track a specific index or sector, but unlike index funds, they are traded on stock exchanges just like individual stocks. So this means you can actually buy or sell them throughout the trading day, which gives you more flexibility.
So if I want to make a quick move, an ETF might be the better option. Are there any other key differences between index funds and ETFs?
Historically, ETFs have had slightly lower expense ratios, which are the fees charged by the fund manager. However, that gap has been narrowing in recent years, making both options very cost-effective for investors.
So it's kind of becoming more of a level playing field.
It is
Anything else to consider?
taxes can be a factor. So ETFs tend to be more tax efficient than index funds because of how they're structured. When you sell an ETF, you're essentially selling it to another investor on the stock exchange. So there's usually no need for the fund manager to sell any underlying stocks to meet your redemption request. However, with index funds, the fund manager sometimes has to sell holdings to pay out investors who are selling their shares. And that can trigger capital gains taxes for all investors in the fund, even if they haven't personally sold any shares.
Wow. So ETFs might have a slight edge when it comes to taxes. It seems like both index funds and ETFs offer a lot of advantages, especially for beginners. It's like choosing between two delicious flavors of ice cream.
I like that analogy.
Mhm.
Yeah, both can be great choices, and it really often comes down to personal preference and individual circumstances. So, if you're on a tighter budget, an ETF might be more appealing because you can often just buy one share or even fractional shares. If you prioritize tax efficiency, ETFs also have an edge, but for that long term, set it and forget it, investing the differences might not be that significant.
So it's about finding the right fit for your individual needs and investment goals. But let's say our listener wants to be a bit more hands-on with their investments. So
Yeah.
maybe they're not content with just tracking the market with index funds or ETFs. they actually want to try their hand at picking individual stocks.
That's fantastic, and it's a perfectly valid approach, especially as you gain more experience and confidence.
Mhm.
But before jumping into individual stock selection, it's really crucial to understand how to read stock data. Like, what do all those numbers and acronyms actually mean?
Right. And the resource you shared actually walks us through a real-world example using Ally Financial, and it breaks down all those key data points, like the ticker symbol, the current
Hmm.
stock price, the days trading range, the 52-week range, the trading volume, the market cap.
Hmm.
Like, it's a lot to take in.
It can be, but understanding those data points is really like learning the language of the stock market.
Okay.
So, for example, let's take trading volume. High trading volume usually indicates that there's a lot of interest in the stock,
Okay.
which makes it easier to buy or sell quickly.
Right.
But a low trading volume can mean that the stock is less liquid.
Yeah.
So it could be harder to execute trades at your desired price.
So high volume is like a busy marketplace, lots of buyers and sellers.
Exactly.
And low volume is like a quiet corner store.
I like that. Okay, and then there's market cap, which stands for market capitalization. And this tells you the total value of all the company's outstanding shares. So it's a measure of the company's size and overall worth.
Okay, so if I'm comparing two companies, one with the market cap of like $1 billion dollars and another with a market cap of $100 billion, dollars, I can immediately see that the second company is much larger and more established.
Exactly. And as you become more familiar with these key metrics, you can really start to use them to compare different companies and identify potential investment opportunities and make more informed decisions.
It's like having a decoder ring to unlock the secrets of the stock market.
I like that.
I do. But let's not get too caught up in the technical details just yet. I was particularly amused by the way they described bull markets and bear markets in the material you sent.
Ah, yes, the animal analogies. So a bull market is when the market's kind of charging ahead, prices are rising, and investors are feeling optimistic.
Yeah, like a bull strong and unstoppable.
Exactly.
And then you have the bear market when prices are falling and
Oh.
investors are more cautious,
Right.
maybe even hibernating a bit, waiting for the market to recover.
I like that visual.
It works. Those analogies definitely make it easier to remember. And speaking of market forces, there's this concept called quantitative easing, or QE. I think it's worth mentioning. It's basically when the Federal Reserve pumps money into the economy to try to stimulate growth.
Yeah,
So it's like giving the economy a financial boost, like a shot of espresso.
I like that.
What impact does that usually have on the stock market?
Well, it can be a bit complex, but generally speaking, QE tends to lead to rising stock prices, at least in the short term. But it can also lead to inflation, so it's a bit of a double-edged sword.
I'm sensing a future deep dive dedicated entirely to QE.
Mm-hmm.
But for now, it's good to be aware of this concept and how it can influence the market.
Absolutely. And while we're on the topic of those kind of more advanced concepts, there's also the strategy called shorting, which involves betting that a stock's price will go down. It's a much riskier strategy, usually employed by more experienced investors, but it's good to at least be aware of it.
It sounds a bit like financial acrobatics. Definitely not something I'd attempt as a beginner.
Agreed. Best to stick to the fundamentals until you're feeling more confident. Now let's shift gears to a topic that's not always the most exciting, but it's crucial to understand for smart investing: taxes.
I know taxes aren't exactly the life of the party, but they can have like a significant impact on our investment returns.
They can?
So we got to address them.
We do. The good news is you only pay taxes on the profit you make when you sell a stock, which is called a capital gain. So if you buy a stock for $100 and sell it for $150, you'll only pay taxes on that $50 gain.
Okay, that makes sense. But I've heard there are different tax rates depending on how long you hold a stock.
There are.
Can you explain that a bit more?
So if you hold a stock for a year or less before selling it, that's considered a short-term capital gain.
Okay.
And it's taxed at your ordinary income tax rate. But if you hold the stock for more than a year, it becomes a long-term capital gain,
Okay.
which is taxed at a lower rate.
Ah, so patience can pay off in more ways than one.
That's right.
Lower taxes and potentially higher returns from compounding.
Exactly.
Are there any other tax tips we should know about?
Well, if you happen to lose money on an investment, you can actually use that loss to offset taxable income up to a certain limit. So even though losing money is never fun, it can at least help you reduce your tax bill.
Okay, so there's a potential silver lining even when things don't go as planned. Anything else?
Yeah. We should also mention that dividend and interest income is taxable as well.
Okay.
You'll receive a 1099 form from your brokerage that reports all of this income, and you'll need to include it on your tax return.
So it's important to stay organized and keep track of all those tax forms throughout the year. Well, we've covered a lot of ground in this first part of our deep dive.
We have.
We've explored those compelling reasons to invest in the stock market, demystified what stocks actually are, and even dipped our toes into that fascinating world of different investment styles and the ever-important consideration of taxes.
It's been great.
It has. And in the next part, we'll build on this foundation by delving deeper into some real-world examples and practical strategies that can help you put this knowledge into action. Welcome back to your personalized deep dive into the world of stock market investing. In the last part, we covered the basics, the historical performance of the market, what stocks represent, all the different investment styles out there, and the tax implications to keep in mind. But I'm eager to kind of get into the nitty-gritty of actually building a portfolio.
Absolutely. So now that you have a good grasp of the foundational concepts, we can start to explore how to actually apply them in a practical way. So let's kind of revisit those investment styles that we talked about earlier. Buy and hold, traders, speculators, and dividend investors. Each one kind of comes with its own set of strategies and considerations.
Okay, let's start with buy and hold, since it's often recommended for beginners.
Mm-hmm.
And it seems like a pretty straightforward approach. But I'm curious, is it really as simple as just buying stocks and forgetting about them?
Well, not exactly. While the core principle of buy and hold is to hold on to those investments for the long term, successful buy and hold investors still need to do their research and really choose companies that align with their own investment goals. So it's not a completely passive strategy.
So it's not just like throwing darts at a board and hoping for the best.
Not quite.
You still need to have a plan and be selective about the companies you invest in.
Precisely. And a key part of that plan is deciding when to buy those stocks. And that's where this concept of dollar cost averaging can be incredibly helpful.
Oh, yeah. I remember we touched on dollar cost averaging earlier, and it seemed like a pretty clever way to mitigate risk.
It is.
Can you remind me how that works?
Sure. So instead of investing like a lump sum all at once, you divide your investment into smaller portions and invest those portions at regular intervals, say like monthly or quarterly, regardless of the stock price at the time.
So, like, I might buy some shares when the price is up, so when it's down, and over time, like, my average purchase price kind of evens out.
That's the idea. It takes the emotion out of trying to time the market perfectly, which, as we discussed, is extremely difficult even for really experienced investors.
So it's kind of like taking a steady and disciplined approach rather than trying to chase the highs and lows of the market. I can see how that would be especially appealing to somebody who's new to investing and maybe feeling a little overwhelmed.
Exactly. It's a way to reduce anxiety and build confidence over time. Now let's move on to those more active styles. Traders and speculators.
Okay.
These approaches require a totally different mindset and skill set.
Yeah, from what we discussed earlier, it seems like traders are like the day-to-day strategists of the market, and speculators are more like the venture capitalists, like willing to take bigger risks for the potential of really outsized returns.
You got it. So traders are often focused on identifying those short-term price movements. They're analyzing charts and using technical indicators to try to predict where the market is headed next. So they might hold stocks for days, weeks, even just hours, depending on their strategy.
So it's like a much faster-paced game requiring like a really deep understanding of market dynamics and the ability to make quick decisions. Do you have any examples of like the types of tools or indicators that traders might use?
Sure. One common tool is moving averages.
Oh,
So
yeah.
these are calculated by averaging the price of a stock over a specific period, like say 50 days or 200 days. And traders use these moving averages to try to identify trends and potential buy or sell signals.
So it's like looking for patterns in the stock's price history to try to anticipate future movements.
Yeah.
And what about speculators? How do their strategies differ from those of traders?
So speculators often focus on companies or industries that are considered high risk, high reward. So they might invest in companies with really disruptive technologies or emerging markets that have high growth potential, or even so-called penny stocks,
Right.
which are those very low-priced stocks that are often highly volatile.
So it's about making these calculated bets on companies or sectors that have the potential to like really skyrocket in value,
Yeah.
even if they're considered unproven or risky by like the broader market.
Exactly. It's definitely a higher stakes game, and speculators need to be really comfortable with the possibility of significant losses as well as those potential gains.
Yeah, it's a bit like playing poker.
It is.
where you need to be able to like read the cards, assess the risks, and be willing to go all in when you see an opportunity.
Hmm.
But I imagine it also requires a strong stomach.
Definitely. Not for the faint of heart. Now, let's switch over to dividend investors. They often take a more value-oriented approach. So they're seeking out companies that have a history of paying consistent dividends and are likely to continue those payments in the future.
So it's really about generating that steady stream of passive income from your investments. And I remember you mentioned earlier that those dividends can actually be reinvested to buy more shares,
Yeah,
which kind of like accelerates that compounding effect.
precisely. And it's a really powerful strategy for long-term wealth building. So for example, let's say a company pays a dividend of $1 per share and you own 100 shares. That's $100 in dividend income. If you reinvest that $100 to buy more shares, you'll own even more of the company and you'll be entitled to even more dividends in the future. So it creates this really nice cycle of growth.
Okay, so we've kind of revisited those different investment styles, each with its own unique characteristics and strategies.
Hmm.
But before we move on, I kind of want to circle back to a point you made earlier about the importance of defining your financial goals
Yeah,
before you even think about picking stocks or choosing an investment style.
that's absolutely crucial. Your financial goals will really shape your entire investment strategy. So are you saving for retirement? Are you saving for a down payment on a house, your child's education, something else entirely? Having a clear understanding of your goals will help you determine your investment time horizon, your risk tolerance, and the types of investments that are most appropriate for you.
It's like having a roadmap for your financial journey.
It is.
You need to know where you want to go before you can figure out how to get there. And speaking of roadmaps, let's talk about risk tolerance.
Yeah.
How does that factor into the equation?
So risk tolerance is another really crucial consideration. And it basically refers to your ability and willingness to kind of withstand those fluctuations in the value of your investments. And some people are just naturally more comfortable with risk than others.
I think a lot of people, myself included, tend to be more risk averse, especially when it comes to our hard-earned money.
Yeah. And that's perfectly normal. There's no right or wrong answer when it comes to risk tolerance. It's a really personal decision. But it's important to be honest with yourself about how much risk you're actually comfortable taking on.
So if I'm more risk averse, should I just like stick with the safest investments possible,
Right.
like bonds or savings accounts?
Well, even the safest investments carry some level of risk. And keep in mind that generally speaking, lower risk also means lower potential returns. So it's all about finding that balance between risk and reward that really aligns with your individual comfort level.
So it's a bit like choosing a roller coaster ride. If you're a thrill seeker, you might go for the one with the biggest drops and loops. But if you prefer a smoother ride, you might choose a more mellow option.
Exactly. It's about finding that level of excitement and volatility that you're comfortable with. And just remember that risk tolerance can change over time as your financial situation and life circumstances evolve.
Okay, so we've talked about financial goals and risk tolerance. What about diversification? I know we touched on this earlier, but why is it so important? And like, how do you actually go about diversifying a portfolio?
So diversification is all about spreading your investments across different asset classes, industries, and geographic regions to kind of reduce your overall risk.
Okay.
Remember that old adage, don't put all your eggs in one basket?
Yeah.
That's a diversification in a nutshell.
So even if I'm like really excited about a particular company or sector, it's not wise to just put all my money there.
Right, because even the most promising companies can face unexpected challenges. And so by diversifying your portfolio, you're essentially hedging your bets. So if one investment performs poorly, others might perform well, and that helps to cushion the blow.
It's like having a financial safety net.
It is.
Can you give me some examples of how to diversify across different asset classes?
Sure. So the most common asset classes are stocks, bonds, and real estate. Stocks tend to offer those higher potential returns, but they also come with higher risk.
Right.
While bonds are generally considered less risky but offer lower potential returns. And real estate can kind of provide a mix of appreciation, potential, and rental income. But it also comes with its own set of risks and considerations.
So a well-diversified portfolio might include a mix of stocks, bonds, and maybe even some real estate investments.
Exactly. And within each asset class, you can diversify even further. So for example, within stocks, you might invest in large cap stocks, small cap stocks, international stocks, and so on.
Right.
And within bonds, you might invest in government bonds, corporate bonds, high yield bonds.
So it's about spreading your risk across different types of investments, both within and across asset classes.
Exactly.
It sounds like diversification can get pretty complex.
It can be, but it doesn't have to be overwhelming. A good starting point is to consider using index funds or ETFs that are actually designed to be diversified. So, for example, there are index funds and ETFs that track the entire global stock market. Or you could choose funds that focus on specific regions or sectors.
So I could use index funds and ETFs to kind of build a diversified core portfolio,
Yeah.
and then maybe add some individual stocks or other investments around the edges as I gain more experience and confidence.
That's a great strategy. And as your financial goals and risk tolerance evolve over time, you can kind of adjust your portfolio accordingly. Remember, investing is a journey, not a destination.
It's about adapting to the changing landscape and making sure your investments still align with your overall financial plan. Speaking of planning, let's dive into that process of actually researching and evaluating potential investments. We talked about doing your due diligence earlier, but what does that actually entail?
It's about going beyond the headlines and hype to truly understand the underlying fundamentals of a company or investment. You want to look beyond the stock price and really dig into the details of the business itself.
Okay, so where do you even begin? What are like the key things to focus on when you're researching a potential investment?
One of the most important starting points is to look at the company's financial statements.
Okay.
So these documents provide a snapshot of the company's financial health, including its revenues, expenses, profits, assets, and debts.
I've heard of financial statements,
Mhm.
but I'm not exactly an accountant. Are they really that important for the average investor to understand? Absolutely. They provide a wealth of information about how well the company is managing its money and whether it's generating enough profit to kind of sustain its operations and invest in future growth.
Okay, so financial statements are kind of like a financial checkup for the company.
Exactly.
What are some of the key things to look for when you're kind of reviewing these statements?
One important metric is revenue growth. Is the company's revenue increasing year over year? This can kind of indicate that the company is expanding its market share or launching successful new products or effectively managing its pricing strategy.
So it's a sign that the company is kind of gaining momentum and attracting more customers. What else?
Profitability is another really crucial factor. You want to see if the company is generating a healthy profit margin, which is essentially the percentage of revenue that's left over after all those expenses are paid. A high profit margin can indicate that the company is operating efficiently and has a competitive advantage in its industry.
So it's not just about making money, it's about making money efficiently.
Yes.
Are there any other key metrics to look for in financial statements?
Debt levels are another really important consideration. You want to see if the company has a manageable amount of debt relative to its assets and earnings, because too much debt can be a red flag. It might kind of indicate that the company might be struggling to meet its financial obligations.
Okay, so it's a bit like looking at someone's credit card debt.
Yeah.
Like a little debt might be manageable, but like a mountain of debt can be a sign of trouble. What about cash flow?
Yeah.
I've heard that term thrown around, but I'm not entirely sure what it means.
So cash flow is essentially the movement of money in and out of a company. It's really a measure of the company's ability to generate cash from its operations and then invest that cash in future growth. So, a healthy cash flow is really essential for the company's long-term sustainability.
So it's not just about having money in the bank, it's about having money that's actively circulating and
Yeah,
being used to grow the business.
exactly. And when you're analyzing a company's financial statements, it's important to look at trends over time. So is the company's revenue growing steadily? Are its profit margins improving? Is its debt level decreasing? These trends can really give you insights into the company's overall trajectory and its potential for future success.
It's like looking at the company's financial story rather than just a single snapshot in time.
Exactly.
Okay, so we've talked about the importance of analyzing financial statements. What other factors should investors kind of consider when they're evaluating a potential investment?
Another crucial aspect is assessing the company's management team. Are they experienced? Are they competent? Are they ethical? Do they have a clear vision for the company's future?
So it's not just about the numbers, it's also about the people at the helm. How can you gauge the quality of a management team?
So you can research the backgrounds and track records of those key executives, look for leaders who have a proven track record of success in their industry, and, people that are respected by their peers and have a clear understanding of the company's challenges and opportunities.
It's like doing a background check on the people who are steering the ship.
Right.
And what about the competitive landscape? How do you evaluate that?
So you want to understand the company's position within its industry. Does it have a strong competitive advantage? Is it facing intense competition? Are there any potential disruptors on the horizon? Understanding those competitive dynamics can give you a lot of insights into the company's long-term prospects.
So it's about analyzing the industry as a whole and seeing where the company fits in. And finally, what about growth potential? What are the signs that a company is poised for future growth?
So look for companies that are innovating, companies that are expanding into new markets or developing new products or services, or maybe even benefiting from favorable industry trends. You really want to find companies that have a clear path to future growth, even if they're not necessarily the biggest or the most well-known companies in their industry today.
It's like spotting those hidden gems
Yeah,
before they become mainstream.
exactly.
It sounds like evaluating a potential investment is a bit like detective work.
It can be.
You have to gather clues, analyze the evidence, and make an informed judgment.
You got it.
Okay, so we've talked about defining your financial goals, assessing your risk tolerance, diversifying your portfolio, taking a long-term perspective, and doing your research. Is there anything else that's kind of crucial for success in the stock market?
Well, I'd say one of the most important things is to stay informed. The stock market is constantly evolving, so it's essential to keep up with the latest news, trends, and economic developments.
Knowledge is power,
It is.
especially in the world of investing. But it can be really overwhelming to know where to even start. Any advice on how to stay informed
Right.
without, like, getting information overload?
I would recommend starting with reputable sources of financial news. So,
Mhm.
places like the Wall Street Journal, the Financial Times, Bloomberg, or Reuters. You can also find excellent insights and analysis from financial bloggers, podcasters, and YouTube channels. Just be sure to kind of vet your sources carefully and avoid those who make really unrealistic promises or promote those get-rich-quick schemes.
Right. It's about finding trustworthy sources that provide, like, balanced and objective information.
Yeah.
And, don't be afraid to ask questions. Like, if you don't understand something, there's no shame in seeking clarification.
Absolutely. The more you learn, the more confident you'll become as an investor. And remember, investing is a journey, not a destination. It's really about continuous learning, adapting, and growing your knowledge over time.
I love that. It's about embracing the process and enjoying the ride.
Yeah.
We've covered so much ground today, from investment styles to diversification to due diligence. We've really explored the essential foundations for successful stock market investing. Are you ready to dive into some real-world examples and specific strategies in the next part?
Absolutely. So we'll take everything we've discussed today and see how it really translates into building a portfolio that aligns with your own goals and risk tolerance.
Welcome back for the final part of our deep dive into stock market investing. We've covered a lot of ground from, understanding the different investment styles to the importance of diversification and due diligence. But now let's shift our focus to actually putting all this knowledge into action. Like, imagine our listeners ready to take that first step and start building their portfolio. Where should they begin?
Well, the first practical step is to choose a brokerage account.
Right.
This is going to be the platform where you'll actually buy and sell your investments. Think of it as your financial command center for all things investing.
Okay, so it's like choosing your spaceship before you embark on an intergalactic adventure.
I like that.
There are so many options out there. What are some of the key factors to consider when making this decision?
You're right, there's no shortage of choices these days. But that's actually good news for investors because it's led to more competition and lower bills. A lot of brokerages now offer zero commission trading,
Right.
which means you can buy and sell stocks without paying any fees.
That's a game changer for sure. It removes a barrier that used to be a major obstacle for smaller investors. But beyond trading costs, what else should our listener consider?
A few things come to mind. First, you want to consider the types of investments that are offered by the brokerage. Do they offer a wide range of stocks, bonds, ETFs, and mutual funds? Some brokerages might specialize in certain types of investments, so it's really important to choose one that aligns with your own investment goals.
Right. If you're interested in investing in, like, international stocks or emerging markets, you want to make sure your brokerage offers access to those markets. What else?
Another factor is the research and educational resources provided by the brokerage. Some brokerages offer extensive research reports, market analysis tools, educational materials, and even access to financial advisors.
Wow.
This can be really helpful, especially for beginners who are still learning the ropes.
Yeah, it's like having a built-in support system to guide you along the way.
Exactly.
And what about the user experience? Is that something to consider.
Absolutely. So you'll want to choose a brokerage with a platform that's easy to navigate, intuitive to use, and accessible on your preferred devices, whether that's a desktop computer, a laptop, a tablet, or your smartphone.
It should feel seamless and empowering, not like clunky and frustrating.
Exactly. It's also worth checking out the brokerage's customer support options. Do they offer phone support, email support, live chat? Are they responsive and helpful? You want to make sure you can easily get assistance if you encounter any issues or have any questions.
Right. Okay, so it's about finding a brokerage that feels like a good fit, one that meets your needs, offers the right tools and resources, and provides a positive user experience. Once you've chosen your brokerage and funded your account, it's finally time to start investing.
Yes,
This is where it gets real.
it is. And this is where all those concepts we talked about earlier, from investment styles to diversification to due diligence all come into play. So if you're leaning towards that buy and hold approach, you might want to start by researching individual companies that align with your investment goals and risk tolerance. Or you could explore index funds or ETFs that track a broad market index like the S&P 500.
Okay, let's say our listener is intrigued by the idea of actually picking individual stocks.
Yeah.
Where do they even begin? How do you go about finding companies that are actually worth investing in?
There are a few different approaches you can take. One is to start with industries or sectors that you're passionate about or that you have some knowledge of. So, for example, if you're a tech enthusiast, you might naturally gravitate towards researching companies in the technology sector.
So you can leverage your existing interests and expertise to kind of guide your research. That's a great tip.
Another approach is to think about problems that you personally experience or needs that you see in the world around you. Are there companies out there that are effectively addressing those problems or meeting those needs? Those companies might be worth investigating further.
It's like turning your everyday observations into investment inspiration.
Exactly. And of course, you can always turn to trusted financial resources for ideas. Read financial publications, follow industry analysts, listen to podcasts like this one.
Yeah, that's a great plug.
Just kidding, of course. But the point is, there are plenty of resources available to help you identify potential investment opportunities. The key is to be selective and discerning. Don't just blindly follow the hype or jump on the latest bandwagon.
Right. It's about doing your own research and forming your own conclusions. Once you've kind of identified some companies that pique your interest, what are the next steps?
This is where that crucial due diligence phase comes in. It's about going beyond the surface level and really understanding the company's business model, its competitive landscape, its financial health, and its growth potential.
Right. We don't want to just buy a stock because it has a catchy name or a cool logo. We want to make informed decisions based on solid research. What are some of the key things to focus on during this research phase?
As we discussed earlier, it's important to dig into the company's financial statements. Look at its revenue growth, profitability, debt levels, cash flow. Are these numbers trending in the right direction? Are they in line with industry averages or better? These are all questions you really want to be able to answer before investing.
So it's about looking beyond the hype and really understanding the underlying fundamentals of the business. What else should our listener consider?
It's also crucial to assess the company's management team. Are they experienced, competent, and ethical? Do they have a clear vision for the company's future? A strong management team can be a huge asset,
Right.
while a weak one can be a major liability.
It's like choosing a captain for your ship. You want someone who knows how to navigate the waters, make sound decisions, and inspire the crew. And what about the competitive landscape? How do you evaluate that?
You want to understand the company's position within its industry. Does it have a strong competitive advantage? Is it facing intense competition? Are there any potential disruptors on the horizon? Understanding those competitive dynamics can really give you a lot of insight into the company's long-term prospects.
So it's about analyzing the industry as a whole and see where the company fits in. And finally, what about growth potential? What are the signs that a company's kind of poised for future growth?
So look for companies that are innovating, that are expanding into new markets, developing new products or services, or maybe even benefiting from favorable industry trends. You want to find those companies that have a clear path to future growth, even if they're not necessarily the biggest or most well-known companies in their industry today.
It's like spotting those rising stars before they become like household names. It sounds like a lot of work.
It can be, but remember, you don't have to be a financial expert to do this. There are plenty of resources available to help you. And the more you practice, the better you'll become at analyzing companies and making those informed investment decisions.
Okay, so let's say our listener has done their research. They're feeling confident about a particular company, and they're ready to take the plunge and buy some stock.
Okay.
What happens next?
It's time to place your order with your brokerage. Most brokerages offer a variety of order types,
Right.
but the most common ones are market orders and limit orders.
Can you explain the difference between those two types of orders?
Sure, so a market order instructs your broker to just buy or sell the stock at the best available price at that moment.
Oh.
It's the quickest way to execute a trade, but you don't have control over the exact price that you'll pay or receive.
So it's like saying, just get me in or out of this stock at whatever price it's trading at right now.
Exactly. It's often the best option if you're not too concerned about getting a specific price and want to execute the trade quickly.
Okay, and what about a limit order?
So a limit order actually specifies the maximum price you're willing to pay to buy a stock, or the minimum price you're willing to accept to sell a stock.
Okay.
So it gives you more control over the price, but there's no guarantee that your order will be filled if the stock doesn't reach your specified price.
So it's like setting a price target and saying, don't buy or sell this stock unless you can get it at this price or better.
Precisely. It's a good option if you're patient and willing to wait for the right price. Once your order's executed, congratulations.
Yes.
You're officially a stock market investor.
That's a moment worth celebrating.
Yeah.
But it's not the end of the journey, right?
Absolutely not. Investing is an ongoing process. It's important to stay informed. You want to track your investments, rebalance your portfolio periodically to make sure it still aligns with your goals and your risk tolerance.
It's like tending a garden. You need to nurture your investments, make adjustments as needed, and be patient as they grow. We've covered so much ground today, and I feel like our listener now has a really solid understanding of what it takes to be a successful stock market investor.
We've definitely explored a lot of the key concepts and practical strategies.
We have.
But the most important message I want to leave our listener with is this. Don't be intimidated. The stock market can seem really complex and daunting at first, but remember, every successful investor started somewhere. With the right knowledge, a patient mindset, and that willingness to learn and adapt, you can absolutely achieve your financial goals.
That's a great reminder. It's about taking that first step, learning from your experiences, and never giving up on your financial dreams. Happy investing, everyone.